Hey everyone, and welcome back to the Weekend Retail Wrap-Up. I'm Ray Kang, commercial real estate broker here in Texas, and I work with owners of strip centers. This is your weekly breakdown of what's happening in the economy and the retail industry, and most importantly, what it means for your commercial real estate investment. This week, we are calling it the value vortex, and here's what I mean by that. Consumers are still spending, retail sales are up year over year, and consumer confidence actually ticked up this week, and this is a big but, they are ruthlessly choosing where they spend. Discount retailers are winning, casual dining chains are struggling, and strip center owners, they're sitting in a very good position right now. We've got some big news on mortgage rates and a very important story specific to commercial real estate that I want to share with you toward the end of the video. So let's get into it. The Conference Board released its February consumer confidence reading this week, and it came in at 91.2. A slight improvement over January's reading of 89. Now, on the surface, that sounds like good news, and it is marginally. But here's what I want you to pay attention to. The Short-Term Expectations Index, which measures how Americans feel about their income, their business conditions, and jobs over the next 6 months, came in at 72. Anything just below 80 on that index has historically been a signal of a potential recession ahead. And we just hit 13 consecutive months below that threshold. 13 months in a row. So what's dragging it down? The same things your tenants' customers are talking about: prices, inflation, and now increasingly trade and politics. Mentions of trade concerns jumped in this month's survey, and that tells us tariff anxiety hasn't gone away just because the Supreme Court had a ruling last week. Now, there's a nuance, and it matters for retail real estate. Consumers are still planning to buy things. Big ticket item purchase intentions rose this month. Used cars, furniture, TVs, and smartphones. People are stressed, but they're not paralyzed. They're just being selective about where their dollars go. This is big news, and it directly impacts your world as a property owner or commercial real estate investor. Freddie Mac released its weekly survey on Thursday, and the 30-year fixed mortgage rate dropped to 5.98%. That is the first time it has been below 6% since September of 2022. A year ago at this time, the rate was 6.76%. That's nearly a full percentage point of improvement in 12 months. For context, that difference on a $300,000 home purchase is roughly $150 to $180 per month in mortgage payment savings. And that matters for consumer purchasing power, and it matters for housing market activity. Now, what's driving it? Part of it is the Federal Reserve holding its benchmark rate steady at 3.5 to 3.75%, while markets price in future cuts. Part of it is actually the tariff court ruling from last week. That ruling reduced market uncertainty, which pushed bond yields lower, which brought mortgage rates down with them. The 10-year Treasury dipped below 4% this week. So why does this matter for strip center owners specifically? A healthier housing market drives more household formation, more move-in activity, and more demand for services and goods your tenants sell. Think flooring, furniture, home improvement, grocery. Lower rates are a rising tide for neighborhood serving retail, and we'll take it. The Census Bureau reported that total U.S. retail and food service sales were essentially unchanged month over month in January at around $735 billion. Flat, not a pullback, and not a surge. And on the surface, that could look neutral, but dig into the data and there's a story worth noting. The personal savings rate has dropped to 3.5%. Consumers are spending down reserves, and increasingly, they're financing every purchase through buy now, pay later, and installment plans. According to Payments Intelligence, installment plans are now embedded in everyday monthly budgets for a growing segment of American consumers. This isn't just for big purchases anymore. People are using BNPL, or buy now, pay later, for groceries and household goods. So what does that tell us? It tells us consumer demand is being maintained artificially in some cases, propped up by credit and deferred payment structures. And that's fine as long as employment holds, but it does mean the consumer is more fragile than the top line spending numbers suggest. As a landlord, that's a signal to pay close attention to your tenant's own financial performance, especially in casual dining and discretionary apparel categories. Red Lobster. Remember when they filed for bankruptcy and closed over 130 locations? Well, they're back in the news this week, and not for good reasons. The chain is now reviewing its remaining real estate portfolio for additional closures in 2026. Here's the math that's crushing casual dining, and it applies beyond Red Lobster. Food costs are up 35% over the past 5 years. Labor costs are up 35%. Menu prices have risen 31%, and that still isn't enough to cover expenses. Customer traffic declined 1% across the food service industry just last quarter. The CEO told the Wall Street Journal that sales are up about 10% from last year's bankruptcy lows, but they have returned to pre-bankruptcy levels, and many locations still need significant renovations. For CRE investors, lesson here is casual dining, especially sit-down seafood, steak, and family dining, is a category you want to monitor very carefully in your tenant mix. These are not the tenants carrying strip centers in 2026. The category to watch is fast casual, QSR, and especially beverage-forward concepts. Drive-through coffee and specialty beverage is outperforming most other restaurant segments right now. Coresight Research released its Week 8 tracker this week, and there's some genuinely encouraging macro data for brick and mortar retail. In 2026, Coresight projects approximately 7,900 store closures. That's actually down 4.5% year over year, and they're projecting about 5,500 new store openings, up 4.4% from last year. That is a positive trend. But who is opening matters just as much as how many. The leaders in new openings this year: Dollar General, Aldi, Tractor Supply, Barnes & Noble, Sprouts Farmers Market, and Floor & Decor, and Home Depot. See the pattern? Value, grocery, home improvement, specialty. These are the tenants thriving in the current environment. These are the tenants your strip center needs. On the closure side, GameStop continuing its long decline, Walgreens pushing through their 1,200 location reduction plan, Francesca's pulling back. The story here is a clear bifurcation. The market is rewarding tenants that serve everyday needs at competitive price points, and it's punishing those that don't. For the markets I work in, San Antonio, Austin, and the Rio Grande Valley specifically, this trend toward value and service retail is exactly what our suburban strip centers are positioned to capture. The growth corridors in these markets are seeing strong demand from the exact categories that are winning nationally. Quick update on a story that has major implications for Texas retail real estate: Fat Brands. The parent company of Fatburger, Johnny Rockets, Round Table Pizza, and Twin Peaks filed Chapter 11 bankruptcy on January 26 with approximately $1.3 billion in debt. The company also delisted from NASDAQ effective February 4th. This week, the story got even messier. A group of bondholders holding nearly $1 billion in company debt filed to have CEO Andy Wiederhorn suspended without pay, alleging he sold 9 million shares of Twin Peaks without required court approval. Fat Brands fired back, calling it a personal attack. So why does this matter for Texas? Twin Peaks has 114 locations across the U.S. and Mexico with significant Texas concentration. These are high square footage sports bar concepts, exactly the type of large format tenant that occupies anchor and junior anchor positions in strip centers and power centers. When a 6,000 to 8,000 square foot tenant in that category goes dark, it takes time to backfill. If you own a center with a Twin Peaks, a Smoky Bones, or any Fat Brands concept as a tenant, now is the time to be proactive, not reactive. Know your lease, know your options, and have a conversation with your advisor about contingency planning. The Wall Street Journal published a piece this past Monday, February 23rd, by reporter Peter Grant titled, AI Anxiety Has Found Its Way to Real Estate Brokerage. It is the most complete and most grounded piece of reporting I've seen on the topic. I am going to walk you through the full story and give you the quotes that matter most, and then very specifically explain why retail strip center owners should be reading this with a different lens than office building owners. So here's the backdrop. 2 weeks ago, 12th, commercial real estate service stocks got absolutely hammered. CBRE fell nearly 20% over 2 trading sessions, its worst performance since COVID. And here's the part that matters. It happened on the same day CBRE reported record quarterly revenue, record earnings, and a 2026 outlook that beat Wall Street expectations. Its shares still fell 8.8% that day alone. JLL, Cushwake, Newmark all nosedived, wiping out tens of billions of dollars in market cap. The market wasn't reacting to fundamentals, it was pricing in fear. This WSJ piece digs into exactly what that fear is about, and there are 2 distinct threats worth understanding separately because they are not the same story. Threat 1, AI is disrupting the brokerage business model itself. The journal reports that AI startups are flooding into commercial real estate with tools that compress research timelines and automate analytical work. The most pointed quote in the piece comes from Francis Huang, co-founder of Apers AI, a startup that builds AI systems for capital allocation in commercial real estate. He put it this way, quote, "The threat is the 28-year-old broker with AI who can deliver in 2 hours what used to take you 2 weeks." And at the very end of the article, the line that I think every advisor, broker, and property owner in this industry should read twice is, AI doesn't replace you. It arms your competition with the ability to build relationships faster than you can maintain yours. AI does not replace you. It arms your competition. That is not a technology story. That is a competitive strategy story. And it is a direct challenge to every advisor in this business who thinks the status quo is a safe place to stand. The journal also notes the broader industry expectation that AI will steadily squeeze margins. The long-standing model of showing up to client meetings backed by armies of researchers and analysts is, as the article puts it, likely going away. Cheaper research and faster execution will push clients to demand a share of those savings. The appraisal segment is called out specifically. The journal notes that niche CRE businesses depending heavily on mostly public data face an outsized AI threat. CBRE's own CEO, Bob Solentic, told the journal that CBRE has already automated parts of its appraisal work overseas, driving down revenue per appraisal but boosting volume and profitability. The largest CRE firm in the world is using AI to compress one of its own revenue lines. There is also a cautionary historical note in the piece that every CRE executive and investor should sit with. The journal points out that CoStar disrupted this industry once before, building dominance over building data and market intelligence that the big firms once controlled and now pay CoStar dearly to access. JLL CEO Christian Ulbrich told the Wall Street Journal back in 2019, CoStar's rise was one of the biggest failures of our industry. It describes the arrogance of the successful incumbent. The journal is implying clearly that the same arrogance applied to AI could produce the same outcome. The KBW analyst Jade Ramani asked a particularly sharp question on the JLL earnings call last week, and I want you to hear it because it maps directly to how this risk gets parsed by investors. Quote, "Would you agree that there is more disruption risk at the low to middle market part of the landscape?" Quote, "That is the segmentation question. The high end of the market, complex, relationship-driven, multi-$100 million transactions may hold. The mid-market, standardized deal, that is where AI disruption is most likely to bite first." The second threat is AI shrinking the office using economy itself. The office using economy. The journal calls this potentially the biggest long-term risk. Not that AI replaces brokers, but that it reduces the number of office workers over time, which means fewer desks, fewer floors, fewer leases. CBRE CEO acknowledged it directly. If there are fewer office workers in the long run as a result of AI, there will be less demand for office space. Large office REITs like SL Green are already down more than 15% this year. The shadow is long. Now, critical distinction for retail strip center owners, and this is where I need you to stay with me because this is where the headline can create misplaced anxiety if you're not reading it correctly. Everything the Wall Street Journal is describing, brokerage margin compression, appraisal disruption, the office demand question, is a story about office commercial real estate and high fee institutional advisory services. It's not the story of your neighborhood strip center. Your tenants, the nail salon, the auto repair, the urgent care clinic, the QSR, the dollar store, the barbershop, these are in person, locally rooted, people dependent service businesses. AI is not performing manicures, at least not yet. It is not changing brake pads. It is not staffing the drive through window at your Chick-fil-A. These businesses require a human to show up and a customer to show up. That is not changing. The journal itself draws this line, noting that AI may hollow out white-collar office employment. The experiential and service retail businesses that occupy strip centers exist precisely because they cannot be digitized. And in fact, as AI drives more remote work and more hybrid schedules, as more people spend time in their home communities rather than commuting to downtown offices, those people are spending more locally. More lunch at the neighborhood center, more errands, more services, more daily visits. The suburban markets of San Antonio, Austin, Rio Grande Valley, where I work, are positioned to capture exactly that shift. So here's what I want you to hold from this WSJ article. Understand what it says about where brokerage and advisory services are heading, because those trends are real and they will reshape how commercial real estate transacts over the next decade. But do not let the continued anxiety about office sector disruption or brokerage margin compression bleed into how you think about the value and resilience of your retail strip center investment. These are quite different assets serving different parts of the economy, and right now, your side of that equation is the more durable one. So, in closing, 3 takeaways for retail strip center owners and investors this week. Number 1, your tenant mix is your investment thesis. Value retail, grocery anchored services, QSR, and daily needs tenants are outperforming every other category. Casual dining exposure is the risk to manage proactively before lease events force a reactive conversation. Number 2, mortgage rates below 6% are a window worth taking seriously. The most favorable borrowing cost environment in over 3 years expands your buyer pool, improves cap rate dynamics, and unlocks strategic decisions you may have been deferring. Q1 2026 is worth a fresh look. And number 3, read the Wall Street Journal AI piece, then separate the office narrative from your retail reality. The disruption described is real for office commercial real estate and brokerage models. It is not the story of your strip center. Your tenants serve communities with services that cannot be automated, and that remote work growth may actually increase demand of neighborhood retail over time. And that's a wrap for this week's Retail Weekend Wrap-Up, week of February 23rd. If this content was valuable to you, share it with another property owner who needs to be paying attention to these trends. If you own retail real estate in San Antonio, Austin, or the Rio Grande Valley and want to talk through what any of this means for your specific asset, please feel free to reach out. This is what we do every day. Have a great week, and we'll see you next weekend.